Karamfil works for the Bureau of International Settlements. The views of this paper are those of the authors, and they are not the views of the Bank of International Settlements. But if they were, they would be damn good views. So, um, okay, what do we know about options? The literature has largely focused on U.S. equity options, really the S&P 500. Before that, there were some papers on the S&P 100. Um, and a lot of those papers are getting old now, along with the people who wrote them. Uh, so what do we know about options, or what do we think we know? Well, there's the option smile, the fact that relative to the Black-Scholes model, there's a bit of misspecification that out-of-the-money options have higher prices than the Black-Scholes model would predict. Uh, Also, there's a negative option smirk that out-of-the-money put options particularly have higher prices than the Black-Scholes model would predict, at least for S&P 500 index options. And that's attributed, for example, to crash phobia, David Bates' term, that people are afraid of losing a lot of money and are willing to overpay for options. Maybe it's just because those options are hard to hedge, or for other reasons, market makers are able to raise the prices. I do have a 2013 paper with Peter Christopherson and Chris Jacobs showing that the smile is can be the consequence of a variance risk premium. So the third bullet point there of what we know or think we know is that implied volatility typically exceeds realized or physical volatility. In other words, there's a negative variance risk premium. So investors are willing to pay to get exposure to variance risk, which, by the way, is negatively correlated with S&P 500 returns very strongly. And just 2 or 3 short years ago, Ian Becker presented a paper at, I think, the FMA conference at CBOE and several other places. He went on a big tour. It was a paper with Stefano Gio, constructing delta hedge returns on options and claiming that the return on the S&P 500 variance was not significantly different from zero. And he said it probably was zero and it had just gotten lucky in earlier time periods. Well, this made me mad because it challenged my my longstanding beliefs about options, and it made me even madder when I found out he was right. Um, so, in fact, I'll show you that the over the recent years or decades, the variance premium has been negative, but statistically insignificant on the S&P 500, not insignificantly different from zero. So I would like to get in a big argument with Ian Becker or anyone here on in this workshop, and I'd like to win. But the problem is that the only way to convincingly win is to get more data, and it's very costly to get more data on the S&P 500 because right, we'd need several decades of data to conclusively prove that it's different from zero. But we can get data on other options. So we've got a data set with options on 20 different commodity futures. And so futures are quite liquid, making it easy to delta hedge the options. And we've got lots of options on lots of assets. So let's measure the returns on these other assets to find out if those first 3 bullet points, which I thought I knew, are true of assets besides the S&P 500, or maybe our knowledge and received wisdom has been strongly shaped by one particular asset. And once we get a measurement of the variance premium, and just a spoiler alert, it's negative for almost all assets. But once we conclude that the variance premium is negative, I would like to relate it to the equity premium. Right? The equity premium is an enormous puzzle in macro finance. Why is the equity premium so positive? As an option theorist, I'm partial to the variance premium puzzle. Why is the variance premium so negative? Well, if you look at the S&P 500, these things are strongly negatively correlated. So you might think that the variance premium is related to beta risk of the underlying or something else. But Beeson and Schreindorfer did a very interesting illustration of the equity premium and showed that most of the equity premium comes from negative returns on the S&P 500, not positive returns. So I will explain this and elaborate later, but I want you to think about what that means. Um, that if we study the capital asset pricing model or any model with a monotonic pricing kernel, we think that investors want to avoid crash risk. So investors pay lower prices and demand higher returns from stocks because of this crash risk. Right? So you think that investors would demand a premium for risk in the left tail. I'm sorry, you think that investors would demand a premium for risk in the right tail because you don't really need a lot of money when the market goes up. But you think you might be willing to accept a very low premium in the left tail. Empirically, that's not what happens. Empirically, a huge proportion, more than 80% of the equity premium is earned from negative returns. And that contradicts conventional models of macro finance. So it turns out that's related to the variance premium. By measuring the variance premium, we can tell you something about the distribution of the equity premium across high and low states. So I think that's important. And that shows that studying options can inform us more generally about risk premia in markets. So we only have 50 minutes and plus questions. So I would like to jump to to dessert and skip dinner for a couple slides. Here is a graph of the option smile for 20 different commodities. Now, I haven't told you what the data set is or what these commodities are, but if you have good eyesight, you can read that we have 20 different commodities. We have the Australian dollar alphabetically first. We have the British pound. We have a bunch of currencies, metals, grains, stocks, and bonds. And we have computed Black-Scholes implied volatilities. And we've run a linear regression on the moneyness and the moneyness squared. So I'll define moneyness as just the log of the strike price relative to the forward rate. And I'm scaling this by the at the money volatility. So this graph is motivational or inspirational. I'm going to preach that we want to use model-free methods, and my first major slide here depends heavily on the Black-Scholes model, but that's how we think about options. And when we talk about the option smile or the option smirk, this is the graph we're talking about. So it's a great graph. Most of us draw it for our students or show it to them. So here it is 20 different times. Everything is scaled, so the at the money volatility is 1, so that all these graphs are close together visually, because clearly some assets like bonds have lower volatility and others like stocks or gas or oil have high volatility, but we've scaled everything so it crosses 1 in the middle. And what do we learn from this exercise? Well, there's similarities and differences across assets. We see that all of these shapes are convex. One criticism is that this is just the average shape for a commodity, but you'll have to trust us that we've looked at different dates, and this is indeed the shape you see. The curves move up and down a little bit when volatility changes, but this is the typical shape of an option curve for any of these 20 commodities. And their options are basically always convex, or rather implied volatilities are convex in the strike price. But you can see the slope is very different. Of these, most of them slope downward. That's a negative option smirk, if you will. But 8 out of the 20, or 40% of them, slope upward. So it turns out that the S&P 500, the skew is not characteristic of all options, only a little more than half of them. So suppose I wanted to teach my students and show them a typical option or a typical commodity. I could look at this graph and pick one of the red lines. It's got a little bit of a negative smirk and it's still got the smile. Well, I wouldn't want to pick the bottom one or the top one, but this top gray line is the S&P 500. It's got a huge negative smirk. And it's also known to have a large negative variance premium, although the updated data will weaken that. But the point is that in some ways, the S&P 500 is the least characteristic asset among all 20, or the most extreme. So
So,
looking at the, yes, Neil.
no, let me jump in with a question. There's a question from SW. Don't know who SW is, but regardless,
All right.
is there an intuition or an explanation for the seemingly universal convex shape? And also, is there a story for why the S&P 500 is so different?
Yes, great questions. I'm going to address the slope in the next graph. Um, but let me point out that this is basically the average risk neutral distribution. These are option prices. I haven't said anything about the observable or physical distribution of returns. So when we look at this graph, I don't know about you, but I want to say, oh, look, these tail options are overpriced. There's got to be a risk premium, but we don't know. So we have some people in the field, like Neil and myself, who've been doing research for a long time. And I'm proud to say that I've refereed not merely the first paper to find the existence of fat tail distributions, I refereed 10 first papers claiming to be the first option paper that explained fat tail distributions using something that was not log normal. So it's quite possible that people are risk neutral, that is consistent with this graph. Maybe people are risk neutral, but the actual distribution is not log normal. Maybe there are fat tails due to stochastic volatility and jumps. Some of you researchers might want to get on that topic. So, but back in the 80s or 90s, there were a lot of papers written with non-normal distributions, and so it's possible that there is no risk premium at all of any type, but the physical distribution is fat. Nevertheless, this graph is strongly suggestive that there's a risk premium in the tails because the tail implied volatilities are higher than Black-Scholes. So we would like to examine that separately. First, just explain the shape, and then look at the returns to see if the returns on tail options are in some sense higher than the returns on at the money options. So there are two things here. The commonality is the convex shape, and that strongly suggests some sort of tail risk premium. But then there's the slope, the fact that for the S&P 500, for example, the call implied volatilities are actually lower than the at the money implied volatilities. Well, if you look at the 1993 Heston stochastic volatility model, there is an explanation in terms of correlation. Right? Recall that I haven't showed you summary statistics yet, but I mentioned that the S&P 500 is strongly negatively correlated with variance. So you can take any measure of variance or volatility and look at the correlation with returns on a daily, weekly, or monthly level. It's strongly negatively correlated. Some of the others are positively correlated. And on the next graph, I have a scatter plot of the slope. And the slope is just literally the geometric slope of these curves at the money, a very crude measure of the option SMARC. So I've compared that to the correlation of variance, which I haven't told you how it's measured, but it's very robust. The correlation of changes in variance with the SMARC here, and it turns out there's almost a perfect relationship. And this point on the lower left here is the S&P 500. It's got the biggest negative correlation, approaching negative 60% or so, and actually negative 60 or 70, and it also has the biggest negative slope. So assets that are positively correlated with volatility have a positive SMARC, and assets that are negatively correlated have a negative SMARC. Right? And that's natural because if you're negatively correlated, that means when the market goes down, volatility rises. And when volatility rises in the left tail, it spreads out the distribution. So, for example, we see sometimes large market downturns over a month of, say, 3, 4, or 5 standard deviations. Now, how do you lose 4 standard deviations in the market. You don't lose it 1 standard deviation at a time. What happens is you get what I call the double whammy. You lose some money and volatility doubles. And then you lose another 1 sigma, but this time the second 1 sigma is a lot bigger than the previous sigma. And maybe you get a triple whammy. You get unlucky 3 times in a row, but each time you get unlucky successively, the volatility is larger and you lose more money. So a negative correlation gives you a fat left tail, and a positive correlation gives you a fat right tail. So this graph shows that, yes, the Heston 93 model works in the cross-section, that there's a strong relationship between the correlation between volatility or variance and the underlying return, the physical skewness, the skewness of the actual distribution, and the option skewness or skewness of the risk-neutral distribution. So going back to the first graph, if you're wondering why some of these are upward sloping and some are downward sloping, well, we understand most of that. It doesn't mean there's not an additional risk premium, but we understand the major differences. And the second question, the second part of the question Neil kindly asked is, what about the convexity? What's going on there? Is there an explanation? And the explanation in the 2000 Christopherson Heston Jacobs paper has to do with volatility risk, that volatility has a negative variance premium, and at the money options have the highest vega. So at the money options should have the highest variance premium, or most negative variance premium, and out of the money options should have less of that. This will induce a smile through absence of arbitrage. So so there is a theory that the variance premium shows up in the tails, and I'll show more of that later when I discuss the Biesen-Schweindorfer anomaly. All right, so this is all motivation here. These are pretty graphs that are very suggestive, but they don't prove anything in any controlled way, and they depend on the Black-Scholes model, which might not be true. So let's take a deep breath and say, I want to compare option returns across 20 different assets, which are quite different assets. The level of volatility is different. The available options, the strike prices that are traded are very different. And the correlation between variance and the returns are different. And there are different methodologies I might use. And we would like to use a uniform methodology across assets. So previous authors like Bakshi and Kapadia, or Duke Becker and Stefano Gio, they just delta hedge an option using sometimes the Black-Scholes deltas or sometimes Hull-White deltas. So already we've got a model dependency, and we've got a data issue. Do you choose at the money options? Do you choose puts or calls or straddles or strangles? And it's kind of a problem if different researchers are using different measures as well as different methodologies and different deltas. Of course, we all love creating models and digging up data, so there's an irresistible temptation, but I want to get everyone on the same page. And the problem with using a single option is that a single option will drift away from the money, even if it starts at the money, and it will lose vega sensitivity. So a single option is probably not a good measure of the variance premium, because most of the time it might lack good vega sensitivity. Other methods do sophisticated things, and so we have what I'll call math geeks doing option research, and we have econometric or data geeks. And I'm trying to bridge the gap and right, be a double nerd. But what these people will do is take something simple like the Black-Scholes model and create a volatility surface. Then they'll smooth out or interpolate that volatility surface, and they will compare implied versus physical volatility. But the problem is that when you take a nonlinear interpolation of implied volatility, you no longer have a tradable price. So Eugene Fama would never condone this when measuring market efficiency or asset pricing. You need to measure an actual tradable return to infer the variance premium in a way that everyone will agree with. Another problem I have with this nonlinear interpretation is that It's tedious to code and compute. They're just slow on a large data set. And interpolation never adds information. Interpolation can only destroy information or sort of smooth it out. But it makes you much more confident in your results because interpolation smooths away the errors and makes you think the results are more reliable than they might otherwise be. You're not actually increasing the true underlying data. Okay, so I want to measure the variance premium consistently or uniformly across assets, but with model independent portfolios. So I don't want to assume the Black-Scholes or any other model. I want to avoid interpolation, or you might say I have another type of interpolation borrowed from Markowitz. Instead of averaging implied volatilities, I average prices, and I call the result a portfolio. Right? And I compute returns on the portfolio, which are simply averages of returns on the options inside the portfolio. And that actually is a tradable return strategy. I'll do this in a model-free way so that it's an implementable tradable strategy. And if you think, what is the best portfolio to measure variance? Well, the VIX, the Chicago Board of Options Exchange Measure of Volatility, that corresponds to the variance. And that corresponds to a portfolio, except that the CBOE portfolio, the formula, is not actually a portfolio. So I'll tell that story in a second, but the CBOE formula is not suited to measuring variance, but a proper formula that's very similar is. And say, okay, so you have a new formula for variance, Steve and Karamfil, and you say it's better than the CBOE formula because it's an actual portfolio. But there are a lot of portfolios we could use. We could use strangles, straddles, all sorts of model-based formulas. What makes you say that yours is variance? And the answer is the data say so. I'll show you that returns on this formula are 99% correlated with observable realized variance. So whatever the true variance portfolio is, it will be damn highly correlated with this one. So so what we do is we measure 20 different commodity futures, their returns from a data set published by iVolatility. We have S&P 500, we have 10-year and 30-year Treasury bond futures and options on those futures. We have around 3 or 4 currencies. We have energy, metals, and grains. So, I mean, many people in this workshop have done work with equity options. And equity options are great, but they're similar assets. And these assets are very different. So I want to measure the most diverse assets available, and this is the best data set we could find for that purpose. All right. So I thought that the S&P 500 had a very large and negative variance risk premium, but it turns out it's smaller than a lot of other assets because it got sort of unlucky over the past 1 or 2 decades, and it's not statistically significantly different from zero. And I'll show you that the COVID month of March 2020 cut the variance premium in half. But even without that effect, it's still not significant. So agriculturals and treasuries have a very negative risk premium. And 19 out of 20 futures have a negative variance premium. The only exception is the Swiss franc. And Karamfil, who's on this workshop now, he lives, I believe, in Basel, Switzerland, working for the Bank of International Settlements. So he's our man on the ground with the Swiss franc. A few years ago, they had some currency realignment or something, and there was an enormous return in one particular month. So there's one big outlier on the Swiss franc that explains why it doesn't have a negative variance premium. So with that small exception, all these commodities have a negative realized variance premium over our sample. And I would like to show you that the negative variance premium and for the S&P 500, the negative correlation can explain the Bese-Scheindorfer anomaly and show you, for example, that a positive variance or a positive correlation can actually undo the Bese-Scheindorfer anomaly. So that's a nice and sort of positive result from our work. So this methodology is forthcoming in a paper about seasonal momentum in option returns, but I need to review it to explain why it's useful. So in that other paper, that is joint with Chris Jones, Mehdi Khorram, Haitao Mo, and Shuai-Chi Li. We used individual stocks, and this portfolio uses commodity futures. So why is this a good, uniform, consistent way of measuring variance across assets? Well, if I could, I would use the SIBO formula because that's published every day and it's easy to download. But there are a couple problems with it. Um, One is that there's no published derivation. So uh, here's the true story of how we got the new VIX formula, which everyone probably mentions in the classes they teach. Mark Cuban, the guy from Shark Tank, went to SIBO, or I'm sorry, he went to Goldman Sachs, said, hey, I need to hedge my stock portfolio and I don't want to sell stocks. I want to buy VIX because I've noticed that VIX is 70% negatively correlated with the stock market. So I want to buy VIX to hedge my stock portfolio because I think that a big dot-com crash might be coming eventually. And Goldman Sachs said, well, you can't buy VIX because it's not a stock. It's a number we publish. And Mark Cuban said, hey, the customer's always right. And Goldman said, well, we can construct an option portfolio called the variance portfolio, and the price is basically VIX squared, and we can sell that to you. And Mark Cuban said, oh, I'm too sharp for you. You want to sell me variance because when the volatility doubles, you can charge me 4 times as much money. I'm not overpaying. I want to buy VIX, not variance. So they asked SIBO to list futures on VIX, and they took a formula from an old Emanuel Derman paper on variance swaps. Now, in continuous time, there's an equivalence between variance swaps and an option portfolio, but in discrete time, with a finite number of strike prices, this equivalence is broken. And Emanuel Derman's formula never described an actual option portfolio. So if you don't have a portfolio, you can't measure the return on it. Emanuel Derman and I left Goldman in 2002 after they went public. And then Mark Cuban went to Goldman in 2003, and a couple non-quants, Sandy Rattray and Devesh Shah, borrowed the formula from Derman's old paper to create the new VIX. Anyway, so we've got a new formula we use, which is a tradable portfolio. And this new formula works with unequally spaced strike prices. That's not a problem with the S&P 500 because the S&P 500 has lots of strike prices, and at the money, they're very finely spaced and they're equally spaced. But if you're doing numerical integration, you have to include the width of the strike prices, and they vary for our available options on commodities. And the new formula, it will allow unequally spaced strike prices, and it's more accurate. For example, the SIBO formula sometimes produces negative variance. That's not good, right? How are you going to compute volatility if you take the square root of a negative number? So the new formula is just very similar, but more accurate and more robust to the data imperfections. And the new formula is a portfolio of options and a little delta adjustment of the futures contract and the risk-free asset. And here's the nice part, that the return on this option portfolio, delta hedged, is going to be approximately the realized variance divided by the implied variance, which is the price, or the VIX squared, -1. So there have been sort of two camps in empirical options research. There have been the implied volatility guys, and I'll throw in all the variance guys, the Garch guys, Rob Engel, and the time series econometricians. And they've been measuring variance and comparing implied volatility to realized volatility, often using Black-Scholes implied vols or some model implied vol. And then there's people who computed returns saying, look, we don't need any model. We'll just form option portfolios or delta hedged options and measure the returns. It turns out that if you use this particular portfolio, those two approaches are almost identical. And I'll show you 99% correlated. So there's an old literature on variance expectations and implied versus future volatility as forecasts. Um, this, uh, this new equation reconciles those two things.
Steve, let me jump in and call your attention to the time.
All right, I appreciate that. Um, let me, what time is it? Oh, I've got my cell phone here. I see that. Thank you.
Okay.
Yes. All right. So this formula is an option portfolio. It looks very similar to the SIBO formula. The SIBO has a different little epsilon, which is a typographical mess. But this little epsilon is a portfolio of stock and bonds, or if you will, futures and bonds. And the problem is that we don't have an option with a strike price equal to the forward price. So instead, you have a K0 as the first strike price below and K1 above. And this epsilon is a little portfolio of stock and futures that interpolates between those two strike prices and gives us a tradable portfolio and a very accurate formula. So here is the payoff to the VIX portfolio or VIX squared portfolio. It's a U shape that looks kind of like the return squared. If you're familiar with it, great. If not, just know that it's flat when you're at the money. And so if you delta hedge this to keep it flat at the bottom, um, you get a small return, which is like a squared change daily, and we will hedge this portfolio daily. The nice thing is we don't have to trade options because this portfolio will always look like this, and we will only delta hedge it, which is very easy to do using futures. So the I volatility data has 20 futures, which I've already shown you. We've got Australian dollars, stocks, bonds, oil, gas, gold, silver. We've got live cattle, and we've got soybeans and other grains. So we've got everything. And all right, 2006 to 2020. The SIBO formula uses 30 days to expiration, and they interpolate options to do that. I don't have a problem with interpolating on prices. So you can compute a 15-day portfolio, and you can compute a 45-day portfolio and take the average, which is still a portfolio with 30 days to expiration. The problem is you can't hold it for 1 month because if half your portfolio has 15-day options, you've got to exercise them or sell them and buy longer options. And then you've got to pay a lot of bid-ask spreads, and it's a nightmare. Instead, we're going to buy options with 28 days to expiration on the third Friday of the month, and then hold them until the third Friday of the next month. So we don't have to trade options. We just buy it and hold it. Or like the old TV commercial, set it and forget it. And we're going to delta hedge daily. So we have zero delta every day, and we have good variance exposure every day. Okay, so here we have a bunch of the commodities, more interesting ones. You might say, well, this is a complicated methodology. And I'd say, no, it's not. You just form this portfolio with a formula we give you, you delta hedge it. The delta is model independent. The delta is just 2 divided by the forward price. So there's a nice simple delta that is model free. You say, well, why not just form an at the money straddle? That's easier to explain to students or my colleagues. So yeah, that sounds like a good idea, but here we have the average actual return. Oh, I'm sorry. Yes, we have the average actual return, and here we have the variance swap approximation. So you can take the ratio of realized variance to implied variance, which is the cost of the portfolio, minus 1. And these two numbers are very similar. The difference is that the first one is an actual tradable return strategy, and the second number calculates realized variance as the sum of squared daily returns. If you could write a custom over-the-counter variance swap, you could get it, but otherwise, it's just a number you calculate, not a return. And there's a very strong correspondence between these things. So it turns out the traditional variance approach is very similar to this particular return strategy. In fact, if you look at the correlation, this is a time series correlation. It's often 99% or even 100% for these things. And oh, it's really low, only 97% for the 10-year Treasury bond. But this portfolio deserves to be called the variance portfolio because its monthly return is almost perfectly correlated with the observable time series variance computed using daily data throughout the month. All right, you say, well, yeah, but any option portfolio should be highly correlated with variance. And it turns out that's not true. Here we have the correlation between a straddle and the realized variance, or variance swap return. And that can be 40%, 30%, or even lower, 18% in some cases. So this portfolio works a lot better than straddles to compute variance or to approximate the effective variance. On this note, there's an old literature looking at, like Andrew Ang and co-authors, looking at whether there's a variance premium in stocks. I don't have a strong opinion on that, but my point is that if you want to measure the variance premium, you want an asset that is very sensitive to variance. That suggests options would work, and this option portfolio in particular. So, is the variance premium positive or negative? Well, I told you before, but now I have the actual numbers. The variance premium is negative on all of these assets except for one, which is the Swiss franc. And again, that's due basically to one massive outlier on a monthly return. Right? Where's the S&P 500? Here we have negative 11, I'll call it negative 12% return. Well, that's pretty negative, but it's not the most negative. I see that the Treasury bond return, that is the variance of the Treasury bond return, loses twice as much money. Crude oil loses about the same amount. Natural gas loses a little more. Cattle even more. So there are a lot of assets with bigger variance premiums. So I started this lecture with a graph of the option smiles and said, look, the convexity suggests that there's a variance premium, but is it fat physical tails or is there an actual variance premium? And there is indeed a variance premium. Okay. And this says a lot of what I stated. Here, we've recomputed the S&P 500 return pre-COVID, and instead of a negative 12% return, we get a negative 22.9% return. So that COVID month was very big, but we don't have to rely on that for our evidence. And we have lots of other negative returns, and many of them are statistically significant. We also have some summary statistics here on the skewness and kurtosis of the monthly returns. And if you look at the S&P 500, the S&P 500 had very strong, well, it had strong kurtosis and strong skewness, particularly the skewness. So the S&P 500 is different from a lot of other assets. And you might not want to rely on it for your evidence about the variance premium, but when 19 out of 20 are negative, you're pretty confident something's going on. And that includes assets like wheat, which have a positive correlation between variance and return, or the Japanese yen also has, a reasonably strong positive correlation of 27%. So positive, negative correlation, it doesn't matter. There's always a variance premium. Now I'm getting to our final finding, which is going to require a little development, which involves Beeson and Schreindorfer's equity premium dissection puzzle. So when I first saw this paper, I was I thought, oh, this is too darn simple. who wrote it. And I realized David Schreindorfer had done a lot of meticulous technical work of the kind that I like, that I do, and many people here did. And he's capable of doing some very confusing, complicated math stuff that I love, but he managed to find something extremely simple to measure the equity premium. So the equity premium is just the average market return in excess of the risk-free rate, right? You could just take the average return, but he decomposed it. He took the physical return, I'm calling that F, the physical distribution, and integrated the return over the physical distribution. That gets you the average return. Okay, well, in other words, he integrated the histogram to take the average. Well, okay, but why? But he also integrated the risk neutral distribution. So every day he would use options to extract a risk neutral distribution, and he would integrate the return against the risk neutral distribution. And you say, why? Well, the average difference is equal to the equity premium over the whole sample. But if you do it this way, you've decomposed the equity premium into the average difference between the risk neutral and physical distributions, and you can take butterfly spreads to measure the risk premium or return premium for every Arrow Debreu security at every strike price. So you can measure the distribution of the equity premium. Do you earn it from out of the money puts, from out of the money calls, or from at the money options? So the equity premium is just the average over the entire distribution, but he defined this function x saying you don't integrate it over the whole distribution, you just define it integrating up to some point x, and then you normalize it by the whole equity premium so it ends up at 1. So starting from the left tail, we can say how much of the equity premium is explained by risk premium earned up to point x for any fractile x. And that measures whether the equity premium is earned in the tails or at the money or elsewhere. Are there any questions about this? Because I think it's an interesting or sensible and pretty easy thing to do, especially when my co-author Karamfil takes charge and handles all the option data to compute this option curve every month and, of course, the overall histogram.
There aren't any questions in the chat, so I think,
Okay.
I should give some.
All right. So here is the Beeson and Schreindorfer graph. The red line is the data. And what we see is that it goes up, and of course it ends up at 1. They didn't emphasize this, but the graph actually goes up close to 1. It gets up to about 80% by the time it reaches at the money options, and then goes up a little more and actually overshoots 1. I want to emphasize that part as a second part of the dissection premium, but this is a dissection of where the equity premium is earned. If you do any sort of macro finance, you're unable to explain the equity premium, and that's an issue with macro finance. Suppose you look at this whole graph and you look at models. So Barrow and Wachter and others have talked about gigantic disaster risk, right? Well, if there's a big enough disaster where the stock market goes down 99%, I'm not sure what bonds would be worth either. But in any case, yeah, if you have an enormous disaster, you can get an equity premium due to negative returns, but it's only due to the rare disaster. It's not due to negative 10 or 20 or 30% returns, which is where we see most of the equity premium coming from. There are other models like habit formation or Bonsa your own long run risk and persistent path dependent preferences. No, that doesn't explain it either. So the data look very different from conventional models, and that is a puzzle. It's a dissection puzzle. It doesn't tell you why there's the level of the variance premium, but it just says that 100% of the equity premium has to occur somewhere in the distribution, but it's a puzzle about the distribution of this premium. What does that have to do with the variance premium? Well, I'll show you. First, we replicated this anomaly for the S&P 500, which is in black here. if you look there, almost 80% of the equity premium comes from negative returns, and not large disasters, but kind of small negative returns. You know, 10, 10 or 20% per month. I mean, that's a nasty negative return, but it's not a huge disaster risk. We did this with the S&P 500 and also with all our futures, where the S&P 500 has only 5% weight. Um, and we get very similar patterns. Of course, in fact, with the other futures, we get up to almost 100% of the equity premium being explained by negative returns. And there's a slight drop there. And the S&P 500 in our sample goes slightly above 100%, very slightly, before plateauing at 1. That's strange. Well, what happens with the variance premium? Well, Karamfil calls Beeson and Schreindorfer BS. I think of Black Scholes when I see that, but all four of them ignored the variance risk premium. Um, that the variance risk premium occurs when variance is high, and variance is high in the tails of the distribution. Again, you don't lose 4 standard deviations by getting unlucky over a sample of a few decades with monthly returns. You lose 4 standard deviations because the standard deviation doubles, and then you get unlucky and lose 2 standard deviations, which is still bad luck, but it happens. So a negative variance premium creates fat tails in the risk-neutral distribution, fatter tails than the physical distribution, right? Well, fat tails in the risk-neutral distribution mean that tail options are overpriced, and it means that there's a negative return on those options. Well, here we have a simulation, actually not even from an asymmetric GARCH, but a simple arch model with a negative variance premium or a positive variance premium. Now, arch is cheating a little bit because in arch, the innovation in the variance is literally the squared stock return. But of course, we know that arch and GARCH models work well in forecasting variance, and big stock returns, positive or negative, do tend to be associated with increased variance. So this is just the simplest stylized model. When we put in a positive variance premium, we have a positive parabolic effect. We earn high returns in the tails, and we get the red line, which looks very similar to Beeson and Schreindorfer's pattern. Here it looks like you get 60 to 70% of the variance premium from negative returns. But when you put in a negative variance premium, or I'm sorry, a positive variance premium, you get the opposite effect. You get very little of the equity premium earned from left tails, and most of the equity premium earned from right tails. So what happens is the risk premium is not one-dimensional, it's two-dimensional. It depends on the stock realization and on the variance realization. And what we're looking at here is a one-dimensional projection of the two-dimensional distribution onto the stock returns, right? So the variance tends to be high when the stock return is very high or very low. So we're looking at high variance in the tails and low variance in the middle and the projection of that premium. And we see a variance premium can generate the Beeson and Schreindorfer effect, theoretically. But there's another effect, which is the correlation effect associated with option skewness. All right, I'm going to wrap up very soon. Recall that we had option skewness where some options were positively correlated and some were negatively correlated. And if there's negative correlation between variance and skewness, then that negative correlation will make variance carry the variance premium into the left tail. But if there's positive correlation, it will carry the premium into the right tail of stock returns. So we separated the assets into ones with a correlation bigger than 20%, right? A negative correlation less than negative 20%, or a positive correlation between variance and returns greater than positive 20%. And when we do this, the assets with negative correlation are in red. They show a very strong, even amplified Beeson and Schreindorfer dissection anomaly. The, the amount of the variance premium is more than 100% for negative returns. It peaks above 100% and then declines, right, earning a negative equity premium for positive returns, right? That is in the right tail of the distribution. But for assets with a positive correlation, the variance premium gets carried to the right tail instead of the left tail. And you get, well, more than 50%, but just a little more than 50%. And again, if you look at asset pricing models, they do have some proportion of the equity premium in the left tail and some proportion in the right. It's not exactly 50-50 because the log normal distribution is skewed and there's, different relative risk aversions and things. But macro risk models put some of the equity premium in the left tail and some in the right tail, similar to this black graph here. So this black graph is not anomalous relative to our asset pricing models, but the red graph is anomalous and even more than the overall distribution. So it appears that this skewness effect, or the correlation of variance with the underlying return, is important not only for the variance premium, but for the distribution of the equity premium for where it's earned. So I can't say that we've explained macro finance, but we've explained it in terms of how the variance premium produces this effect. And our Harvard colleague, Larry Summers, once called option theorists ketchup economists because all we do is say that a 16-ounce bottle of ketchup is worth twice an 8-ounce bottle of ketchup. But this shows that we can reduce the distribution of the equity premium, that the pattern or dissection of the equity premium, we can reduce it to two risk premia, the overall equity premium and the overall variance premium, and if you will, the negative correlation. So these building blocks of options are very useful for macro finance. And this is what I just said, that for positive correlation, the anomaly is what's smaller and not particularly anomalous. But for negative assets, this anomaly is amplified, and we can explain it in terms of a negative variance premium and a negative correlation between variance and returns. So in conclusion, we've measured the variance premium across 20 different futures, and it is negative for 19 and a half of them, the one half being the Swiss franc with a big outlier. The S&P 500 has the biggest negative smirk, but 40% of the options have positive smirks. So that's actually not typical of all options. And the variance premium is related to the evidence on the equity premium and helps us understand, if not explain, the macroeconomic preferences behind the pattern of the equity premium. So that's my conclusion, but I welcome questions and have backup slides if they go outside what I've described so far.
So thanks very much, Steve. So now, oh, there is a question in the chat. Okay. But before I go to the question in the chat, does anyone else have a question? If you do have a question, feel free to unmute yourself and use your microphone.
Okay, I'm looking at the chat. There, what is the intuition behind the convex shape?
That's one that you already answered. Yeah.
Yes. That's the variance premium in the tails. Slide 3 again explain the slope. Okay, the futures risk premium is just the average return on the future. You could say relative to the risk-free rate, but the future is costless. Let me share again to get to slide 3 and show you that smile graph. Here we are. So that smile graph, it is my favorite graph, and it's exactly what you would probably do if you were willing to make large compromises and just wanted to get a graph of the option smile. Well, we computed implied volatilities on options of all moneyness. So we created little moneyness buckets, and we ran a regression on log of moneyness and log moneyness squared. So we computed this M number which is the log of the strike divided by the forward price. The point is that you can have options that are 200% out of the money if they're call options, but you can't have put options that are 200% out of the money because they would have negative strikes. So we just took the logarithm, which gives you geometrically symmetric measure of the strike price relative to the forward price, and we scaled that by the at the money volatility. So this would start off at let's see, at so this is 0 when you're at the money, but then it gets positive or negative, and we ran regressions of the implied volatility for different levels of moneyness on the moneyness to get the parabolic smile we associate with the implied volatility curve. So if you did this on any one day, you would get the option smile for that day, and we just averaged the option smiles across all months for each commodity, so we could have one smile for each of our 20 assets. Right? I hope that's clear and succinct. If not, I'm happy to talk more, or Karamfil can discuss.
Okay. Are there any other questions?
I have one question. May I?
Yes.
Go ahead.
My name is João. My question is the following. You have shown a graph where there was like a kind of failure of macrofinance in explaining the structure of the equity risk premium. And my question is, since you are, if you are not, please tell me, since you are using basically realized variance risk premiums and equity risk premiums, my question, if you had used conditional variance risk premiums and conditional equity risk premiums, would the picture be basically the same? Would it make a difference?
Well, if you want us to calculate conditional risk premia, we're going to need to forecast them. And my stockbroker can confirm that I am not good at forecasting the equity premium. All right. So I learned that long ago, and to an extent, try and avoid trying to forecast it anymore. But I'd say that option theorists are particularly unskilled at forecasting the equity premium, and we like to run regressions and forecast the variance premium. There is a conditional change, but let's see, would this... So I guess the question is, suppose I took particular dates here. Maybe you're good at forecasting the premia and selecting a subset of these dates and redid the graphs. That's an interesting question, and I'll have to think about it. That is, maybe these graphs are different in January and versus February, or during recessions versus expansions, or some other variable. Realize that data are precious here, and we don't have many years. So, but we do have a lot of different assets. The only problem is we'd have to assume that these assets earn their equity premiums and variance premiums in some sort of consistent model. We can't have a different forecasting model for all 20. But that's an interesting question. I will consider that because it might reinforce the conclusions here. Thank you.
Well, thank you so much, Steve. I'm going to echo what Dima said at the beginning. It seems like a very important question, and it seems like it was about time we looked at it across assets. So thank you very much to you and Karamfil for doing this for us, and to you in particular for sharing anecdotes about Goldman Sachs and and whatnot. It's always a pleasure to have you around, and hopefully we'll get to welcome the participants again in 2 weeks when they join us for Vikas Agarwal's talk, and hopefully you'll also be among us, Steve.
Yes. Well, thank you. Let me just mention again, the paper is up on SSRN. So everyone should be able to access it there. Thanks again. This is a wonderful forum, and I can't see who's online right on my screen now, but I'm sure that I know many of you, and we'll see others at conferences. But yeah, this was a fun paper, not deeply technical in terms of model estimation.